Hey, Travis Clayton here, Financial Institutions Practice Group Leader with Rawson Yerger.
Jeremy Nelson, Wealth Management Group Practice Leader here at Rawson Yerger.
Are y'all a wholly owned subsidiary of Rawson Yerger?
Yeah, Element Wealth is a wholly owned subsidiary of Rawson Yerger.
Well, welcome. We're glad to have you and your team with us. Let's talk a little bit about wealth management.
Yeah.
So I was looking at the markets this morning. I was looking at the S&P.
Mm-hmm.
It's up 27% year to date. Does that sound accurate?
Yeah.
Question I would have is, with interest rates going up, obviously fixed income has not been a destination place for money over the last many years.
Yep.
I would have expected to see a lot of money leave the equity markets and flow into the bond world. So I thought there'd be a little bit of a pullback. So what's kind of going on with that kind of scenario right now?
One sector. I mean, so what?
There's one sector.
One sector.
One sector
is driving the S&P 500 right now.
Which
right?
sector?
Tech. Okay, so what we saw was a little bit of a broad-based recovery at the beginning of the year across all sectors. That started to fade. Interestingly, in February, March, when we went into the banking crisis, right, where you saw a few of the regional banks going under because of their treasury management programs. Essentially, the Fed reversed course, right, on their quantitative tightening, and they put a little bit more liquidity into the market. They built up their balance sheet, and at that same time, AI started being kind of the talk of the town, and all of a sudden you just had a continued massive rally in tech. If you go under the hood of this market, though, we saw last month the Dow crossed and went back negative for the year. If you look at high dividend stocks, those are negative on the year. If you do a comparison, though, I did this the other day for a client. I said, all right, let's go back to the beginning of 2022. Here's HDV, right? The iShares High Dividend ETF. Here's QQQM, the NASDAQ ETF. And if you look just from this year on, NASDAQ looks great. Dividend stocks look like they suck. But if you rewind it back to the beginning of 2022, high dividend stocks are actually ahead of tech.
Really?
Yes. So what you're seeing is a tectonic shift that is happening longer term. As interest rates go up, valuations are coming down. I think we're
starting to see some of that money from the equity side flow back into
well,
fixed income?
obviously people aren't chasing the rates yet. There's a lot of money sitting in money markets and shorter term treasuries, things like that, because that's the highest yield right now. Now, I believe that's a mistake that people are ultimately going to make. I use the example of the 80s, right? Interest rates skyrocketed. The 10-year treasury was at 15% or so, and people bought CDs because they could get CDs at 18%. Why would I buy a 10-year bond at 15% when I could get a CD at 18? Well, those rates didn't last, right? You could have locked it in for 10 years or more if you just bought the long-dated treasuries. So we're seeing a lot of the money right now focused a little bit shorter term in the fixed income markets. I think that people need to probably start adding a little bit more duration in their portfolios right now. We saw the 10-year treasury cross 5%, fell back down. We're, as of this recording, about 485 right now. But I think that people need to be looking at adding a little bit more duration in their portfolios. With regard to tech rallying, but if we look back to 2022, still lagging other parts of the market, you got to remember what happened when the tech bubble unwound in 2000, right? There were numerous kind of declines, rallies, declines, and it was all
kind of a slow.
It was all along the way,
yeah.
Where over 3 years the market was down 50%.
Yeah.
Right. So now I'm not necessarily
that happen in crypto in the last couple of years. It's been slow, trickle down death. But.
Yeah. And so unless we were to really see true new highs and a real breakout in tech, I still think that we're at the beginning of a normalization in markets. Valuations, if we just look at the PE ratio on the S&P 500, it's sitting, well above historic normals, but interest rates are at historic normals. So this idea that stocks should be trading at a huge premium because interest rates are super low, that doesn't stand anymore. Interest rates are normal, right? So we definitely see room for valuations to contract, and we think that over the coming years, the equity markets are going to be a little bit bumpier.
The diversification. I'm always curious about the manager of managers approach, as well as just your general thoughts on active versus passive management.
This is there's a lot to uncover on this one. So let's just kind of tackle active versus passive.
Okay.
So I am a believer in active management. But the thing that you got to remember when you're selecting either, ETFs or mutual funds, things like that are active, and it's not in a qualified account. Okay, so not in a Roth IRA, 401k, something like that. You've got two hurdles that the manager has to cross. So the manager's got to cross the hurdle of, their fee. So they got to generate enough excess return, right, to beat the fee, but also taxation. Right, because there's turnover inside of that portfolio, and if capital gains distributions come out of the fund, then on a net it's hurting you. Right, so you got those two hurdles that you've got to cross. Now, if we look at very efficient asset classes, right? So let's just say U.S. large cap. U.S. large cap is very difficult on that net basis of fees and taxes for managers to generate excess return. So in a lot of cases there, if we're talking about an after-tax account, we're probably just going to buy beta, right? We're just going to buy the market because you can buy the market super cheap, right? You buy the S&P 500 ETF.
So real quick, beta is a indication of how closely your fund is trading at what
tracking the market, basically.
The market. Yeah. So if we always joked about these passive active managers who have an active fund, and they have a decent management fee, etc. But their beta is one kind of the baseline of the market.
Yeah,
you're like, well, why are we paying for active management? Because we're basically have an index fund.
They have like no tracking error, right? So their portfolio is 70% the same as the S&P 500. Well, why don't you just buy the S&P 500 then, right?
We call them, I remember the term closet indexers.
Yeah, exactly. So, but if you go down into less efficient markets now, right, where information, you can have an information edge, right? So small, mid cap, right? These are areas where historically you've seen managers be able to do a little bit better. International, emerging markets, and then you get into fixed income, and fixed income is a whole nother animal. So I tend to like to concentrate my exposures from an active perspective more towards the international, the small mid cap, and inside of like fixed income. Also, there are diversifiers like alternative investments, whether it's liquid alts or whether it's things like private credit or private real estate, things that we use in some of our portfolios. Okay, that's where it makes sense to.
So I like that approach. So you're talking about a more passive indexing type strategy with large cap stuff. S&P 500 would be great way to go, and then utilizing more active managers and other asset categories to where it could make a difference.
The other thing that we'll do, so let's just say, okay, now we're talking about IRAs, so taxation doesn't matter anymore. So let's kind of go over to that area. Here's where we're going to look at. We're going to say, okay, we're probably going to want to be more dynamic. We're going to want to be a little bit more tactical in the environment that's coming ahead. And so what we'll do is we'll use ETFs, passive ETFs, to create our tactical exposures, right? So we can go, hey, we want to overweight stocks, we want to overweight international, we want to overweight emerging markets, we want to increase our duration, or we want to shorten our duration on fixed income. So that's where ETFs are very, very valuable, and we just use passive ETFs to create those dynamic overweights
when
or underweights.
when I think, and I'm not an expert between the differences of mutual funds and ETFs, but I know that the way that you get into the funds are different. Mutual funds, there's typically a load and there's something coming out on the front end. No.
Not so. Yes, if you go to a broker and just buy a mutual fund,
yeah.
But if you're talking about coming to a registered investment advisory firm,
Yep.
You're paying a fee. There's no loads.
Okay, so there's no. What's the difference then between the mutual fund and the ETF? I know that they trade differently. I was under the impression there was a different expense load to them. Maybe not. So just
not necessarily, right? So I mean, if you go and you look at, let's say the Fidelity 500 mutual fund. Okay, so this is a mutual fund that mimics the S&P 500. Right? It is cheaper than SPY, which is the ETF that tracks the S&P 500.
Is that Spider?
Yeah.
Yeah.
Right. So people, mutual funds in and of themselves aren't necessarily more expensive. Right? Now, mutual funds tend to be more active, right? So there's actual active management going on, whereas ETFs that are active aren't as active. A lot of them are just like smart beta strategies and things like that.
So why would you choose a fund or to use a mutual fund over an ETF or vice versa?
So mutual funds, what happens is all the trades go in throughout the day. You get to the end of the day and all the buys and sells settle, right? The money goes in, money goes out, and the managers, they reallocate and redeem shares as necessary. ETFs trade throughout the day, right? So if you want intraday pricing, then ETFs are the way to go.
Yeah.
The other thing, because of how ETFs are redeemed, they're more tax efficient. Typically speaking, ETFs don't distribute capital gains distributions. So in after-tax accounts, ETFs make a lot of sense. When you strip away the tax benefit and you're going into a qualified account, less so.
Okay, let's talk about qualified accounts because one of Element Wealth's core competencies is 401k administration. So everybody, while everybody has exposure through their 401k, not everybody is having these conversations or understand some of the things we're talking about here. So what's your general advice to employers that are administering a 401k plan, as well as to the individuals who might look up and go, I don't even know where to start. Should I just go with this model that's been created as part of my package, or should I sit down with an advisor and talk through these things? Or I know there's so many online tools that people can utilize, and would love to get your thoughts on those.
Yeah.
So how do you start those conversations with employers and then continue it with individuals?
So from the employer perspective, right, I think that it's important that you hire a fiduciary that's going to be your 338 investment manager, right? So that's what we do. We're taking that responsibility off of you as the plan sponsor. Now, you're still a plan sponsor. It's your responsibility to meet with your 338, review what's going on. But ultimately, the investment decisions are on the 338 investment manager. When you start looking at plan lineups, what you want to do is, this is my belief, we like to create some passive options. So, hey, you've got that participant that just wants super low cost, S&P 500, small cap, EFA, emerging market, whatever basic indexes they want. They just kind of buy into that. They want that low cost. Great. We're going to give you that down the core. But then on the outside, when we're starting to talk about value, growth, fixed income, emerging markets, international, we're going to start bringing in a few more active managers. So we're going to give the participants the opportunity to have managers that are screened and by us, where you've got the opportunity for some excess return. Now, when we get to the participant level, all right, most of the time the QDIA, the Qualified Default Investment Alternative, is going to be the target date series in the plan, because the Department of Labor gives plan sponsors a safe harbor if they use target date funds as the QDIA, which I 100% agree with. Are target dates perfect? No. Now, if I'm a participant that knows absolutely nothing about financial markets and I don't have access to advice, right? There's not an advisor there that's working with the plan, or I'm going to have to figure this out on my own. Target dates are a great place to be. I know there's a lot of people that dog on target dates. Again, yeah, they're not perfect, right? It's kind of one series for everyone, and everyone's financial situation is different. But especially in the early years of accumulation, target dates are great. If you work somewhere where you have access to advice, right? This is where we try to separate ourselves, is on the service side. We provide free financial planning for every participant that wants it in any retirement plan we service. Like, that's our value proposition.
Sure. How many groups do you find out there? What's kind of the percentage of ones that have advisors attached to the plan and ones that do not?
So,
do you have any clue?
Most actually have an advisor or a consultant. Now, whether or not that advisor or consultant is actually servicing the plan
and engaged
is a whole separate conversation, right? So most have them. Most their advisor's not that engaged. It's a 401k has been sold to someone. It was, this was my fraternity brother, or this is my brother-in-law, and he's in the business, so I gave him my 401k. But they're not actually doing what they're supposed to be doing from a servicing perspective. But when you can work with, a professional, a lot of times on certain platforms we'll run managed models, so we can kind of customize things for the individual participant, or we'll say, hey, let's talk about all the assets that are over here. What's going on in your spouse's accounts? We'll kind of work with them, and we can create a more customized solution for them. But it kind of all depends on where you are in your stage of life. I think that people inherently get too conservative too early in their 401ks, right? This is, you build up a couple $100,000, you're making 60 grand a year, let's just say hypothetically.
Yeah.
And all of a sudden we go into a bear market and your portfolio drops by more than you're making in a year. That's a pretty tough thing to emotionally get over, right?
Sure.
But, you're still 20 years from retirement, let's say. Just keep dollar cost averaging, right?
Pour more money
in, keep saving, keep taking advantage of those matches. Now look, once you start getting up to 50 years old or so, I think you got to kind of do an evaluation of, all right, where am I? Am I ahead of the curve? Am I behind the curve? Have markets been good? Have markets been bad? If markets have been really good, because everyone always talks about, well, the market averages 10% over time. Okay, yeah, over 100 years of data, that's a very accurate statement. But 1982 to 2000, the market averaged 18% a year. Up until 2020, to the end of 2021, the market had averaged 15% a year. Well, that means that there's a whole bunch of periods where the market didn't average 10, right? It had to average well below 10 in order to match up with these really bullish periods to get that average over time. So I think once you get to about 50, you kind of want to look and go, all right, am I ahead? Have the markets been really, really good? Okay, maybe I now want to kind of downshift, be a little more balanced, maybe introduce a little bit more fixed income into my portfolio because, I'm ahead of the game. Or, hey, I'm behind. Or, look, the markets have been really terrible. All right, if the markets have been really terrible, just hold your nose and keep buying, right? And stay more aggressive. And then as things recover and get better, you can make a change. I would strongly advise that people make that decision in conjunction with an advisor.
Yeah.
But I just, over the years of doing this, going on 20 years now, I've seen people get too obsessive about keeping what they've got where they are, and they're still so many years away from retirement.
A philosophical question. Do you see a lot of high net worth individuals who are going to essentially find those funds, go to their kids through an inheritance? Do you see them stay aggressive all the way throughout their lifetime?
No, and that I think is a mistake, and it's something that we talk about with our clients often, which is, I'll give you a great example. So we were doing some Roth conversion analysis for one of our clients, and they had $5 million in an IRA, and so we were looking at, hey, here's what your required minimum distributions are going to be. We've got this window right now while you're retired. You don't have a lot of income. It probably makes sense to do some Roth conversions here. And what I explained to them was, this isn't for you. You're never going to run out of money.
Yeah.
Right. This is about maximizing and optimizing for your kids and grandkids.
Yeah, because if you get conservative and the kids end up here at the money, they're just going to put it back in an aggressive model.
Exactly.
I've never really understood that mentality of getting ultra conservative just to have it at your time of death go back into a very because the kids are going to be much younger.
Yeah, and that's where I think that financial planning, wealth management, right? It's about process. It's about really laying out and articulating the goals that we have for ourselves, our families, our communities, and then aligning assets appropriately, right? I think about all the people who are looking at doing Roth conversions because those required minimum distributions are going to push them back up into high tax brackets. You're really doing that because you want the money to go to your kids instead of the government, right?
Yeah.
And so for us, we really want to lay out those goals. And hey, here are the assets that we're allocating to take care of you and your wife or your husband. And over here, these are really the assets that are for legacy. So let's kind of optimize the best way to do this.
Okay, so Jeremy, say that I own a business, right, and we are the fiduciary of the 401k plan for our employees. What does that mean? What are my responsibilities?
Okay, so this is really good because the first thing you have to realize is that you are a fiduciary, right? If you are a plan sponsor, you are a fiduciary, right? You have responsibility to ensure that the money is for your employees is safeguarded. So the Department of Labor, whenever they do their audits, they bat around 750. Pretty good, right? I mean, that's Hall of Fame right there, but the vast majority of the time, the issues that they find are operational, late contributions, things like that, right?
Okay.
I think that, you have a responsibility to ensure that you are providing, adequate investments, that those investments are being reviewed, and that you comply with your plan document, right? So you've got this long plan document. It says these are all the provisions that are out there, for our plan. Well, you need to make sure that that's actually happening.
Being executed on. Yeah.
Now, the practical reality is, as a business owner, that's not your area of expertise, right? So that's where your record keepers, your third-party administrators, they all come in. And then if you're a large enough business, your auditors are going to come in and make sure that everything's doing right. I think that people get really, really wrapped up in some of the wrong things, right?
Okay.
And ultimately what you just have to do is you've got to recognize that your responsibility. So this is, we're going to say, a normal retirement plan, right? It's at one of the major record keepers, the Nationwides, the Fidelities, right? Our investments are normal. This isn't one of those situations where we've got some profit sharing plan and I've got a vacation rental in there, those, because that's where trouble happens. That's where trouble really, really happens, and people go to jail. But that's not what's going to happen when you're doing like a normal retirement plan. So let's kind of focus on the normal here. The money is safe kept because you've got a record keeper, like a Fidelity or a Nationwide or someone, right? They're holding the money. The money's not being stolen. They're responsible for the cybersecurity and all that kind of stuff of that. Now, you have to ensure that the fees that you are paying are reasonable.
How do we go about doing that?
You have to, our recommendation is that every 3 years or so that you kind of take it to market. It's not necessarily that you're looking to change, but you're just getting bids, you're getting quotes, you're kind of seeing, hey, are the record-keeping fees that we're paying
in line?
Reasonable? Is it in line? It doesn't have to be cheap. And what's happened in the industry is that there was a race to zero. And ultimately what's happened is there's been a massive disservice to participants because things aren't working as well because everything is so lean. You know, the 401k record keepers are cut to the bone at this point in time. I mean,
because they're trying to get fees as low as possible to get a competitive edge.
Yeah. So it's just the only thing people cared about was fees. I mean, and let's just say, you know, hypothetically, you know, I have a $10 million retirement plan, right? Well, 1% is $100,000, right?
Okay.
10 basis points is 10,000, right? You know, a basis point is $1,000. So if someone comes in a couple basis points cheaper, it's a couple $1,000, right? Like when we start looking at this in absolute dollar terms, yeah. And if someone comes in 1% cheaper, okay, yeah, right. That's massive savings. That matters. You know, look, we had a large plan that we came into a few years ago, and I mean, we saved $250,000 for participants just by cutting the fat out from the administration side.
Yeah, that's significant, right?
So as a plan sponsor, look, make sure that your fees are reasonable, and make sure that you have a process around investments, and make sure that that operationally that you've got a team in place that is making the contributions on a timely basis. Now, nowadays with payroll integrations, you know, as long as you've got the right payroll provider, and there's many of them, you just get a 360 integration. And that 360 integration, just everything's automated. You don't even need to touch it. So, you know, make sure that operationally things are working. Make sure that you're reviewing your plan for fees on a periodic basis. And make sure you got a process around how you're evaluating investments. And I think, you know, you're going to be good.
So let's just talk about portfolio management. Let's talk about domestics versus internationals. Obviously, internationals have lagged for some time. They're a little bit more complicated, right? Mm-hmm. What would be your general advice or philosophy about, do investors just need to stay in domestics? And if not, how should they integrate this other asset class into the portfolio?
That's a really, really good question. I am a believer long term that international diversification is beneficial.
Okay.
But recognizing that there are periods of time where it's going to be a real lag. So if you go back and you look at a period like coming out of after the dot-com bust, mm-hmm. okay, and you took a portfolio that was 60-40, right? So we always think 60-40, 60% S&P 500, 40% Bloomberg US aggregate bond, okay? If you took a portfolio that was 60-40, but the 60 was the MSCI All Country World Index instead of the S&P 500, same fixed income, that 60-40 portfolio had all the returns up until the peak of the S&P 500, 100% invested in equities. So when you get the tailwind of international working, it can really boost your returns. The key is the dollar. Okay, that's the number one driver of why international will do better or worse in a portfolio, because we see everything in dollar terms, right? So if I'm sitting there and I'm looking at, you know, a portfolio of international stocks, and the dollar is rallying, right, and you know the euro or whatever other international currencies that I'm owning those companies in, or where they trade, well, they're becoming worth less and less and less and less in dollar terms. If you go back to that period after the tech bubble, okay, the dollar collapsed. Okay. Right? Now, so that became a tailwind to international. Well, the dollar has been strong since the financial crisis, which has created a headwind for international diversification.
Okay.
But if you go and you look at valuations, So whether it's emerging markets or international developed, those markets are trading at major discounts to
So it's
the
a good
U.S.
place to be.
So as I'm looking forward, and you want to talk about Jeremy's portfolio, I am not way overweight there yet, but I mean I think we are starting to see cracks in the dollar. I think that I found it very interesting that Saudi Arabia took rupees for oil, right? So they settled a trade in oil and rupees instead of dollars. I found that interesting. You're seeing, China beginning to dump some of their dollars. So I think that there's a real probability that we go into a bit of a dollar down cycle. And these dollar down cycles don't last a year. I mean, we're talking these are things that last 5 to 10 years. And
well, it sounds like you're talking about it's just a good hedge.
It's exactly
It's
right.
like having gold. It's a good hedge.
It is a great way to be diversified. And I think right now it's a great way to be capturing value. But it's not something that you're going to time, right? It's a strategic piece of the portfolio. And, we've been, kind of a little underweight on international for a long time. I mean, we've had it in portfolios, but we haven't been like acqui-weighted, MSCI All Country World Index. But we are looking at that opportunity to get a little bit more aggressive on the international front.
So you like all world type portfolios as opposed to specific continent sectors, whether it be Latin America, Europe, Asia?
Yeah. So
you like to bundle. You like to be more exposed to all of them.
So I think that what we as managers have to realize is that there's only so much that we can have expertise in.
That's true.
And so within our active portfolios, we'll have international value, international growth, a global manager. We're going to let them do those decisions as to what countries to be in. Mm-hmm. I'll make a decision about how aggressive I want to be on emerging markets versus developed, right? And then let the manager make those decisions. Now, we do.
I think they're all, like, in my mind, like, real quick, kind of give us some guidance on developed versus emerging, because in my head they're all emerging.
Yeah.
Well, that's not the reality, but in my head they're compared to us, they're all emerging.
Well, I mean, but think about think about Europe,
okay,
right?
Stable.
Canada,
stable.
Australia,
yeah,
right? Japan, right? So these are your developed, right? So
your
these
G8.
are, yeah. So these
G8 countries.
So these are the countries that are going to show up in like the MSCI EFA index, right? Europe, Asia, Far East, right? That's the EFA stuff. Gotcha. The stuff that falls into the MSCI emerging markets.
Okay.
So that's where you're going to get more of your, Latin America,
Ecuador.
Southeast.
Shout out to Ecuador.
Yeah, Southeast. Yeah. So wait, weren't they the ones that took Bitcoin as a reserve currency? There was one of them.
Who was it? Was it Ecuador?
It might have
Shout
been.
back out to Ecuador. That didn't work. That ain't working so well right now. But just hold. Just be a holder.
Yeah.
They did do that. I don't know if it was them. It was one of those.
It was one of those South American countries, and I just can't remember off the top of my mind right now. But yeah, so you're going to get your Latin Americas in there,
your
Indias,
your like Southeast Asia markets.
Yeah. But I mean, think about a country.
Indonesia.
Yeah, think about a country like India, right? I mean, where you've got.
Is that that would be developed, right?
No, that's emerging.
Still emerging.
Well, that's still emerging. China is still emerging. So now you've got you've got MSCI and you've got FTSE, and there's some countries like South Korea that can be either or, that are kind of on the verge. But yeah, generally speaking, think about lower per capita GDP in these countries. Mm-hmm. But think about population growth and a lot more long-term GDP growth. And right now, across the board, the cheapest valuations. Now, I go back to 2007. And so we had this massive run, 400% in emerging markets. I mean, it was just a huge trade right at the beginning of my career. Emerging markets were just, out of the park. Europe was doing phenomenal. And we got to a point, though, where the PE ratios, the price to earnings ratios in emerging markets, were higher than that of
domestic.
And, so
what's a real quick? What's a high PE ratio like? 17, 20.
Well, so I think, historically, if you look at the trailing 12 month, the S&P 500 should probably be around 15, 16, right? High, I mean, look, we were just at 40 not that long ago, right? What you really want to look at is more of kind of the forward. The trailing's only telling you what happened in the past. Really your forward PE ratios are what matters more. 16 to 18 S&P 500 is pretty normal right now. We're pushing above 20. So, there's a little bit more room for contraction there. But my point to this emerging market story was that here we are in 2007, and it's the China global commodity demand theme story that's going on. Energy had been really strong, and emerging markets were trading at a higher PE ratio than the U.S. And some people would say, well, they're faster growing, therefore they should have a higher PE ratio. But what was missing in that equation, and where I was like, this doesn't make sense, is the risk, right? It's higher risk. So those future cash flows of those companies should be discounted more because there's more risk. There's geopolitical risk, all kinds of risk that's
risk-based pricing should be factored in.
So emerging markets should trade at a discount to the U.S. because they are less stable, they are riskier, but we're to a point now where they're pretty cheap. I mean, if I'm very, very bullish if I take a 5 to 10 year view on emerging markets.
Okay, so Jeremy, there's a lot of different things we can talk about. Obviously, private markets come to mind. Mm-hmm. What's kind of your thoughts on investments in that area, and what's kind of your advice?
So yeah, this is a very, very interesting topic, because over the last few years, with the evolution of interval funds, the retail investor has been given the opportunity or access to markets that they typically wouldn't have had in years past, right? Typically, when you thought about whether it's private equity or private real estate, private credit, this was reserved for, the institutional investors, right?
Yeah.
So ultra high net worth families, or the Harvards, the Yales, endowments, family offices, etc. Now, what I'm going to say here is I'm going to talk out of both sides of my mouth a little bit, but I'll clarify. Number one, buyer beware, right? There are a lot of new sponsors that are coming out right now. I get emails every single day from new firms or firms that I've never heard of, for private credit or real estate or private equity. And even some firms that I know of, in the alternative space, but I wouldn't necessarily think of them as a private equity manager or something like that. So I think that there's a huge flood of money that's gone into this space, and I think that that's probably distorted pricing. I think that people are overpaying for a lot of stuff, and I think that there's going to be a lot of money that could be lost. Now, let's flip over, because I'm actually a big proponent of having private markets inside of a portfolio. Now, the thing that you're giving up when you're going into private markets is you're giving up liquidity, right? So this is not an asset that's going to trade like an ETF or a mutual fund or a stock, because it can't. So let's just say, I'm invested in a private real estate fund, which we have a private real estate fund that we have a lot of money in. And inside of that fund, we own billions of dollars of either apartment complexes, distribution centers for e-commerce, casinos, whatever it might be that we own. Well, you can't sell that asset, overnight to make up for liquidity demands.
Correct.
So you're giving up some liquidity when you're going into these spaces. But long term, what this is going to do is it can provide you diversification, potentially, or we expect it to enhance returns, right? And again, it's just great from a diversification perspective, right? So anytime that I can boost returns and lower volatility and improve diversification, I'm in. The average person doesn't need access to all of their money instantaneously. So if you're thinking long term, having 10, 20% allocated to good private credit options makes a lot of sense. The key is, who is the sponsor, right? So let's just use private credit as an example. The private credit that we utilize in portfolios, they're not syndicating. These aren't loans where they're breaking it up and they're buying pieces of this and that. No, they're originating, right? They're a massive private equity player. When a company that needs $1 billion comes to the table, they take all of it.
Yeah.
Right. They set the terms. They're in control.
They portfolio it. They're not breaking it up.
Exactly. Right. They've got, the dollars to do it. Or same thing goes, with real estate. We don't want, some small fund that's trying to buy office buildings or retail at a discount. Like, I just want to stay away from those areas, but give me strong income producing portfolios, that's going to give me a nice inflation hedge over time, give me income and growth. I like that, right? I want to put that in my portfolio. I personally have it in my portfolio in a pretty significant way. But again, I think that it's an area where there's a lot of marketing. There's a lot of new players that are coming to the market. And I would just be really, really cautious with who it is that I'm using in that space. Mm-hmm. So again, like there's going to be a lot of money that's lost, but if you're with the right sponsors, I think it's a major benefit in a portfolio.
I got to ask this question because it's on everybody's mind about interest rates. What's your thoughts looking forward on what's going to happen with this rate environment?
Yeah, so I remember about 2.5 months ago, I was sitting in my office. We had a client in, and we were holding a pretty good bit of cash in the portfolio. And I was explaining, it was primarily from the fixed income piece of the portfolio. And I was explaining our view on interest rates. And our view at the time was, the 10-year treasury was at about 385. And we had this massive inversion. Short-term rates were above 5%. We're looking at an inversion in the yield curve like we'd never seen. And, most people looked at that inversion and said, well, the Fed's going to have to cut, right? The yield curve is so inverted because we're going to go into a recession and the Fed's going to have to cut interest rates. Yeah. And our view was, the Fed's going to hold because they've got to finish the job on inflation. And the long end of the curve is just wrong right now, right? We really thought that you would get a flattening of the yield curve and that it wasn't going to be because rates were going to get cut. We think the Fed's going to get to a point where they're going to pause here, but that long rates were going to come up and that the yield curve was going to flatten. And ultimately, that's what happened. And it happened really, really, really rapidly. Do I think that long rates could go up a little bit more? Yes. Do I think that they need to go up dramatically more? No. I mean, I think that we are, we're past the 7th inning stretch on this one, right? I mean, I think maybe, we're in the 8th or 9th inning. There's always risk that it could go into extra innings, right? But I definitely think that we're at a point where interest rates are getting up to the level where they need to be. And let's just kind of do some simple math here. For the last decade, right, up until a year and a half ago, we basically lived in a world where, for the vast majority of the time, you had a negative real interest rate, meaning inflation was actually above the 10-year treasury. Today, let's just say inflation's around 3%. We're pushing 5 on the 10-year treasury. That's 2% or 200 basis points of real yield. Over time, that's going to be enough to kind of really dampen inflation and get it down.
I agree.
So I think that the Fed's just got to hold. I think they've got to get up to this level. They've got to continue to unwind their balance sheet, right? And that's going to hold rates up. And I think that's going to be enough to finish off the job on rates.
So my thoughts are, I think given the circumstances,
Mhm.
I think the Fed's done a pretty good job. They've taken some heat. They haven't been perfect, but over just sticking to their guns and doing what needed to be done, I think they've done a fairly decent job. What's your thoughts?
Yeah, I think that they got behind the curve. I remember in 2021 in December, it was like we had like a 1.5% 10-year Treasury, 6% inflation, and the Fed hadn't got off their seat yet, and I was like, okay, this is a little scary. They're gonna have to move. They're gonna have to move fast, and they ended up having to move a lot faster than I think anyone really anticipated. I think in general, though, that the Fed has done a good job since the financial crisis. I remember a few years ago, I was on a call with Ben Bernanke, the former chairman of the Federal Reserve, and politely he said, you know, monetary policy can only bail out bad fiscal policy for so long, right? I think that the issues in our country today revolve more around poor fiscal policy, right? And this is just deficits that have been building up for multiple decades now. So it's not a political statement. This is It's been going on. We haven't balanced the budget since the Clinton administration, right? So you're talking about a long period of time where we haven't balanced budgets. And I think that the Fed has done a good job of getting us through the financial crisis, supporting the economy throughout COVID. Did we go a little too far? Yes. But is going too far better than not doing enough? Probably. Right.
See, I don't know about that. I'll be the first to give them credit on the short term. I think they've done a good job recently holding their guns. They've been under a lot of pressure to get inflation under control, and they've stood to their, they stood up and did what needed to be done. I'm much more critical of them over a longer period of time.
Yep.
I think, policy in general has been, specifically coming out of the financial crisis, we're not going to let anybody lose or fail. And that extends to corporations, that extends to individuals, that extends to sectors, etc. And so I think we've been very aggressive with monetary policy, trying to usher through these crises where we're trying not to let anybody fail.
Yeah.
And I think that's dangerous long term, because the precedent's been set, and we've seen the Fed be used over and over again in these areas to make sure that we're propping everybody up, which morally is a great thing. I just worry about the consequences in reality fiscally. So I'm a little bit more critical long term than I am in the short.
Well, and that's where I go to kind of what Chairman Bernanke was talking about on this call, where monetary policy can only bail out fiscal policy for so long. The fundamental issue is fiscal policy, right? And what the Fed has, they've got two mandates, right? Inflation and full employment, right? And so if you look at it from the objective of reaching full employment, then they achieved their goal, and we staved off a depression. Now, there's part of me that says, man, we should have just ripped the Band-Aid off. We potentially could have had a little bit of a short-term depression. It could have been really, really bad, but we would be like the phoenix that would rise again, right? Instead, here we are 15 years later, and we haven't done anything about it. So I understand that sentiment, and there's that part of me that looks at it and goes, yeah. But if I look at it from the Fed's perspective of, our job is, stable inflation and full employment, then they've executed. And I think that the X factor in all of this is COVID, right? So here's the Fed, right? They're beginning to raise rates. Remember, Trump was all over Powell in 2018 that he was raising rates too fast,
he wanted
right?
Them down.
He wanted them down, right? Yeah, and so what you saw was a Fed that was really starting to unwind their policies, right? And
then boom.
2020 happens.
Sucked right back in.
And they got sucked right back in. And so that's kind of the X factor that's in there. So, if I go back and look at where Powell was pre-COVID, they were moving. Now 2019 they backed off a little bit, right?
every administration, and I say administration just to break up the time periods of 4 to 8 to 4 to 6 years, is going to have an X factor though. Mm-hmm. There's always going to be the X factor that we have to manage through.
Yeah.
It's going to be 9/11. Mm-hmm. It's going to be a financial crisis. It's going to be a COVID. Mm-hmm. You know, there's I'm sure there's an event in there that I'm missing.
Oh, you had things like European debt crisis.
Yeah,
you know,
exactly.
You had 2014, 2015. You know, the energy defaults, right? Where all of a sudden we were producing too much energy.
Oh yeah, there's always going to be an 10, 12 years ago we got downgraded. U.S.
Mm-hmm.
the U.S. got downgraded for our bond rate. Like, there's always something.
It just happened again.
Yeah, to navigate. Anyway.
Yeah, there's always those things, and I do think that, you know, I think that the response went too far, and you know, one of the questions that people would always talk to me, that we're going back, you know, a decade, right? Mm-hmm. So let's go back to 2012, 2013. People would say, you know, hey, the Fed's printing all this money, they're putting it on their balance sheet, you know, it's going to become inflationary, and it didn't, right? And my point was, the initial quantitative easing program was not about, that money never went into people's pockets. All it did was it facilitated the transfer of debt, right, from the private sector to the public sector. So in the form of bailouts, right? Everyone got bailed out. And so all we did was kind of plug a hole, and we put it on the Fed's balance sheet. Now, COVID, right, when that quantitative easing program came out, what it funded was actual stimmy checks. Mm-hmm. And that's why it became inflationary, because all of a sudden, all that money started going into people's pockets and they started spending it. And that's why it became inflationary.
And they had time to spend it.
Yeah.
Boy, did we have time to spend it.
Yes. Well, I was still working pretty hard through then. But
All right. Anything else?
That's all I got.
This has been fun.